Hello there. Welcome to this Level 4 podcast, focusing on budgeting and financial performance, the two key management accounting papers at Level 4. My name's Gareth. If I can see there my contact details, garethjohn@fi.co.uk. I'm a managing director with First Intuition, one of the UK's premier AAT accountancy training colleges. So I'm quite happy if you've got any questions, whether it's about your specific technical studies or more general queries about AAT or other studies you're considering. We've been very, very pleased in the last few years to win some fairly prestigious awards. We were awarded the UK Accountancy College of the Year in both 2010 and 2012. I won the UK Lecturer of the Year for 2011 based on nominations from a lot of my students. I was very pleased to be awarded that. And more recently, we were nominated for Study Resource of the Year in 2013. Now, the concept of these podcasts is to actually pick up on some specific technical areas that sometimes students find a little bit challenging. Just spend a little bit of time trying to make sure that they're clear for you. Well, the area I would like to look at in this podcast is the labour productivity ratios, which can potentially be relevant for both budgeting and financial performance, the two management accounting papers, where you do see in a little bit of detail the financial performance indicators. So you may have come across things like margins and return on capital employed and current ratios, but I want to pick up on the labour productivity ratios. So as we've said, it's an important part of both budgeting and financial performance that we can use performance measures to assess how well a business is doing. Now, that can include financial performance measures, your gross profit margins, current ratios. These are the typical ratios you might have come across. Or they could involve non-financial performance measures, such as looking at defect rates in production or the number of customer complaints we receive. Now, you will typically see tasks in both budgeting and financial performance getting you to do these sorts of things. And one area that students are often quite unfamiliar with are the labour productivity ratios of labour efficiency, labour capacity, and labour production volume ratios. Now, these are the ratios I'd like to take you through, just using some fairly simple numbers here. So, we've got a company has a budget to produce 1,000 units with a standard time of 2 hours per unit. So that's the standard time they're expecting each unit to take. We're then told they actually produced 1,200 units in a total of 2,250 hours. And we're going to calculate these three labour productivity ratios. We're going to look at labour efficiency, look at labour capacity, and look at labour production volume ratios. Well, if these are calculations you have come across, you might want to see if you can have a go at them under your own steam to start with, see what you can remember. Now, if you are familiar with them, do feel free to pause me so you can have a go at each of the calculations. Well, let's start with the labour efficiency ratio. Now, efficiency of labour is looking at how fast our staff were. Did they work faster or slower than we expected? And in fact, if you remember from the original data in the question, we were expecting staff to take 2 hours per unit. That was the standard, that was the expectation. So if they were faster than expected, maybe they only took an hour and a half to make each unit. Now, the way the calculation works for the labour efficiency ratio is we'll look at the expected hours to make actual output divided by the actual hours to make actual output. Now, you might notice that both calculations are based on the actual output. So, in fact, for the purposes of this example, I'm not interested in the 1,000 units they budgeted. That wasn't the actual output. The actual output was 1,200 units. Well, 1,200 units, what would we expect that to take? Well, 1,200 units, the standard time per unit was 2 hours, wasn't it? So, in fact, the expected hours would be 2,400 hours. We then divide that by the actual hours to make actual output. Well, the actual hours that they took was 2,250. Now you can see we expected them to take 2,400 hours, they actually took only 2,250 hours. They've clearly been a bit faster than expected. They've clearly taken a little bit less than 2 hours per unit. Now, if I work the calculation out, 2,400 divided by 2,250, then multiply by 100 just to turn it into a percentage, I get something around 106 point, maybe 7% if I round it to one decimal place. Now, the fact that that ratio is above 100% implies my staff have been fast. In fact, I can see here they've been 6.7% faster than I would have expected. Now, if my staff have been faster than expected, you can imagine ultimately they'll end up producing more units than we expected. So that's labour efficiency. Well, if we then turn to the labour capacity ratio, now if labour efficiency is looking at how fast my staff worked, this is looking at how long my staff worked for. How many hours did they have in which to produce? Because that is the capacity to produce. Now, the way we calculate this ratio is we take the actual hours to make actual output, so how many hours did they work, divided by the budgeted or the planned hours they would have had. Now, we've already seen that the actual hours worked was 2,250. The budgeted hours would be based on the budgeted units. They were budgeting 1,000 units, and remember they were expecting 2 hours each. So in terms of the budgeted hours, it would be 1,000 units times 2. So in fact, somewhere, there must be a budget for 2,000 hours. That's what they were anticipating their staff would need. They've actually worked 2,250 hours. You can see they've worked more hours than we would have budgeted. And if I work the calculation out, 2,250 divided by 2,000 times 100 to turn it into a percentage gives me 112.5%. Now that's telling me that staff worked 12.5% more hours than we were originally expecting. That should lead to a greater volume of production. In fact, can you see so far, we had the labour efficiency telling us they'd worked faster than expected. That should lead to extra units. And we've got the capacity variance saying they've worked longer hours than expected. That should also lead to a higher volume. So ultimately, when I'm looking at the production volume ratio, I should expect it to be well above expected. Well, this final ratio, the labour production volume ratio, looking at how the volume of production compared to the budget. And we can work this out by taking the expected hours to make actual output divided by the budgeted hours. Now, we actually already know these figures. Remember, the actual output was the 1,200 units. The expected hours at 2 hours per unit would be 2,400 hours. The budgeted hours based on their 1,000 unit budget would have been 2,000 at 2 each. If you do 2,400 divided by 2,000 times 100 to again turn it into a percentage, I get 20%. That's actually, 120%. That's actually telling me that the production volume is 20% higher than we expected, which actually makes perfect sense, because if you remember, we were budgeting 1,000 units, and we actually produced 1,200 units, which you can see is indeed 20% higher than we would have expected. Now, we can work out this labour production volume ratio from scratch in the way that I've done there, although you should be able to prove it by considering the efficiency and the capacity ratios. Remember, we said with the efficiency ratio, the staff have worked faster than expected. They've worked 6.7% faster than expected. The capacity ratio tells me they've worked longer hours. They've worked 12.5% longer hours than expected. The combination of those two things is leading to an increase in volume of 20% in total. And in fact, if you multiply the efficiency variance, and I'm going to decimalise the percentage, so 106.7% is 1.067 times, and again if I decimalise the capacity variance to 1.125, if you multiply them together, you should get 1.2, i.e. the same 120%, the fact that the volume was 20% up because staff have been faster and they've worked longer hours.